This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Okay, I'm going to go through question 4 from the March-June 2016 paper F9 hybrid exam. So as always, make sure you've downloaded the question, that you've got it in front of you. So let's have a look. Look at the requirements first of all, then we don't waste time reading through the first bit of the question until afterwards. Part A, calculate the after-tax weighted average cost of capital of DINLA on a market value basis. 8 marks, so that's the main bit of the question. And although we've yet to look at the figures, I mean, clearly a very, very standard topic to be asked. Calculate the cost of capital. Part B, a bit of writing, discuss the connection between the relative costs of sources of finance and the creditor hierarchy. I don't know, it may be obvious or not obvious what they mean, but we'll think about it when we come to it. And part C, completely separate, something you could answer entirely on its own without having looked at the rest of the question. Explain the differences between Islamic finance and other conventional finance. Well, very standard. Chat about it a little bit when we come to it. But if you've read the lecture notes, watched the lectures, or studied from the study text, that should be relatively easy marks. Anyway, let's get on with part A, which is the calculation, and again, the main bit of it. It wants the after-tax weighted average cost of capital, and it tells at the top the capital structure. So we've equity, share capital, and reserves, total of 270,000. There's also the long-term borrowings, the non-current liabilities, and they've got 3 sources: preference shares, loan notes, and bank loan. So as always with cost of capital, we have to work out the cost of each source separately, and then we can get the weighted average, weighting them by the total market values. So let's work out the cost of each one individually first of all. The cost of equity, the ordinary shares. What does it tell us about the ordinary shares? They're currently trading at 4.26 per share, ex-div. The nominal value is 25 cents a share. Dividends are expected to grow in the future by 4%. And a dividend of 25 cents per share has just been paid. Well, we need to work out the cost of equity. And again, if you've watched the lectures, I do say it's best to learn the formula. Otherwise, you've got the growth model formula on the formula sheet, but that gives you the market value when you know the dividends and you know the shareholders' required rate of return. You need to rearrange it. If you're good at rearranging, fine, otherwise it is better to learn it, that the cost of equity is D0 times 1 plus G over P0 plus G, where G is the rate of growth, which gives us what? D0, the current dividend, I've lost the question. The current dividend is 25 cents. I always do it in cents, so I write 25 rather than 0.25, doesn't matter. Times 1 plus G, the growth rate. They're growing at 4%, so 1.04. Over P0, the current ex-div market value, which is 4.26. As I said, I'm doing it in cents. Plus the growth rate 0.04, which comes to 25 times 1.04 divided by 4.26 is 0.0610 plus 0.04, which is 0.101, or of course 10.1%. That's easy marks, very, very standard. But similarly for all of them, what other sources of finance do they have? They've got preference shares, where it's the same formula, except of course preference shares have a constant dividend. And what does it say? The second bit below the capital structure, the 5% preference shares have an ex-div market value of 56 cents per share, a nominal value of $1 per share. And since they're 5% shares, the dividend is 5% of the nominal value. As its nominal is $1, it's 5 cents per share. So it is really the same formula, D0 1 plus G over P0 plus G, but of course a lot easier. The dividend, 5% of nominal value. Again, I'm going to work in cents, so 5 cents. There's no growth in dividends, so 1 plus G becomes irrelevant. Over the market value. The market value is 56 cents. And again, G, there's no growth, G is 0. So 5 over 56 is 0.089 or 8.9%. So again, a nice, quick, easy one. What else? Loan notes. They're redeemable. That's going to need a bit more work. So although I'll do it in the exam, I'm more concerned with getting the marks. So I'll jump it temporarily. What about the bank loan? It's another source of long-term finance. The bank loan, it says nearly at the bottom, it has a fixed interest rate of 7%. And so no tricks. If you're paying 7%, it's 7%. I say no tricks. The only thing is, of course, it's costing us 7%, but bank interest, unlike the dividends we've been dealing with in the other two, bank interest is tax allowable. So they'll pay 7%, but they'll save tax at 25%. And so the net cost will only be 1 minus T, 75%. So the cost of the bank loan, 5.25%. So those three, nice and easy. The remaining one isn't hard, but certainly takes that little bit longer, the loan notes. You should have had enough practice on this to know that if we've got redeemable debt, which it is here, then we're going to have to work out the internal rate of return. So what are the flows? I always do it on 100 nominal. The flows on 100 nominal, there's interest. The coupon rate from the capital structure is 6%. So there's interest each year of $6. But the cost to the company, the interest will be tax allowable at 25%. So as with the bank loan, the net cost will be 75% of 6, which is 4.5, 0.75 times 6. Yeah, $4.50 per year. Each year until redemption. So they're redeemable in 5 years' time. So interest of $4.50 a year, years 1 to 5. In 5 years' time, they're redeemed. And it says they're redeemed at the nominal value of 100. So it's 100 in 5 years' time. And of course, the redemption isn't tax allowable. We need the internal rate of return in that the present value of those will equal the current market value. And what is the market value? They're trading at 95.45 for 100 nominal. So its internal rate of return, not going to have a lecture on internal rate of return, but they obviously are on the website. But 2 guesses. Doesn't matter which guesses you use. What I always do is I say, well, just on the interest, it's 450 on a market value of 95.45, which comes to 4.7. So it's somewhere around there. I'll make my first guess at 5%. And what's the present value? 95 now is 95. The interest, 5 years annuity at 5%. I've lost my tables again. Where on earth have I put them? Here we are. The 5-year annuity at 5% is 4.329. And so the present value of the interest, 450 times 4.329, is 19.48. And the redemption, the ordinary present value factor for 5 years at 5% is 0.784, which is 78.40. So the present value, the net present value at 5%, 19.48 plus 78.4 minus 95.45. I get 2.43 positive. And so for an NPV of 0, the internal rate of return, it must be higher than 5%. Make a second guess, doesn't matter. I mean, I'll guess at 10%. I think the examiner chose something different, but I'll guess at 10. So market value 95 now is 95. The interest, the 5-year annuity at 10% is 3.791. The ordinary discount factor for 5 years at 10% is 0.621. So the present value of the interest, 450 times 3.791 is 17.06. The redemption, 100 times 0.621 is 62.1. And therefore, the net present value, 62.1 plus 17.06 minus 95.45 is 16.29 negative. So the cost of debt, the internal rate of return, it's 5% plus. Now, if you've watched my lectures, you know I don't learn a formula. It's entirely up to you. There's only one answer using these two guesses. But 5%, it was 2.43, so it's a bit more than 5%. It's 2.43 over the total difference, 2.43 plus 16.29, times the difference between my two guesses, 5%, 10%, the difference is 5%, which is 5% plus 2.43 divided by 18.72 times 5.65%. It's 5.65. Now remember, if you've used different guesses, you will end up with a slightly different answer, and that doesn't lose any marks at all. The internal rate of return is never precise anyway because it's not linear. So absolutely no problem. If you use different guesses and get massively different from 5.65%, then you've made a mistake, something's gone wrong. But all you can really say is somewhere between 5 and 6. We're not worried about that being precise. Anyway, I now know the costs of each of the 4 sources. We need a weighting, and we weight by market values. So the 4 sources, there's equity, there's preference shares, there's loan notes, and there's bank. We know the costs, I'll write them down in a minute, but we need the total market values of each source. So let's run through. First of all, equity. They're currently trading at 426, so there's the market value. They have a nominal value of 25 cents per share. So how many shares are there? On the capital structure that is set up, it's got shares with a total value of 23,000. All right, it's millions, but I don't care, it's all in thousands. But that's what's appearing on the statement of financial position. But since the nominal value is only 25 cents a share, the number of shares is 4 times that. There must be, whatever that comes to, 92,000 shares at 25 cents each is how we got the 23,000. So that's the number of shares. The market value per share is 426. So the total market value of the shares, 4 times 23,000 times $4.26 is 391,920. What about preference shares? Their nominal value is $1 per share. So from the statement, there are 5,000 of them. Their market value is 56 cents. And so the total market value, 5,000 shares at 56, is 2,800. What about the loan notes? The loan notes, third paragraph, they're trading at 95.45. The nominal value is 100. And so the market value of them, it's 11,000 nominal from the capital structure. Market value is 95.45 for every 100. And so the market value in total is 10,500. Just let me check that. 11,000 times 95.45. Yeah, 10,500. And finally, the bank loan. Well, always with a bank loan, it doesn't have a market value as such. It's just the amount borrowed, 3,000. So there are the total market values, and the total market value of all of it, the total 391,920, 2,800, 10,500, 3,000. I hope I'm adding up properly. I get 408,220. What are the costs of each individually? Well, as you can see there, the loan notes were 5.65%. Equity was 10.1, preference 8.9. And finally, the bank, I wrote that down, 5.25. And so the weighted average, you do your weighting whatever way you like, whatever way you've learned, but again, there's only one right answer. Equity, a total of 391,920 out of a total of 408,220. Debt, 2,800 out of 408,220. The loan, 10,500 over 408,220. And finally, the bank, 3,000 out of 408,220. If I multiply and add up, let's see how fast I can be. 391,920 divided by 408,220 times 10.1. That comes to 9.7. The next one, 2,800 divided by 408,220 times 8.9 comes to 0.06. 10,500 divided by 4. 0.15. And the last one, 3,000 divided by 408,220 times 5.25. 0.04. I hope my arithmetic's right, but I'm not going to waste time checking, in fact, because, as I say in every question, my workings are set out in a way that it's clear what I'm doing. If I have made an arithmetic mistake there, then I'm terribly sorry, but that is just behalf of mark. It's obvious that I'm doing it the right way, and any error is just kind of silly arithmetic. But what's the total? 9.7, 0.06, 0.15, 0.04. I get a weighted average of 9.95. What did the examiner get out of interest? Oh, he got 9.9. I think mine's slightly more accurate than his. But there we are. That's part A, 8 marks out of 15. And so I'm just getting pass marks on that question. That's what you're aiming for, pass marks on every question. However, as again I keep saying whenever I go through these, if something went wrong on part A, if you got stuck, which you really shouldn't, to be honest, but if you got stuck or you found it was taking you far too long because you're slow on your calculator or something, it's better to leave part A part finished, but still have done something for B and C, rather than just spend all your time on part A and do nothing for B and C. I know part A alone will give you just over half marks, but I don't think in the middle of an exam you can be so confident that you've not just made one or two silly mistakes and then you're below half marks. Whereas B and C, you may not be able to get full marks, but there is absolutely no excuse for not getting some marks on B and C very quickly. B, discuss the connection between the relative costs of the sources of finance and the creditor hierarchy. Now, what does he mean? Part A gave us a clue. If you look at part A, the cost of finance, equity was the most expensive, 10.1. Preference shares were the next most expensive at 8.9. They were cheaper, but more expensive than the other two. The next most expensive was the bank loan, 5.65. And the cheapest, not the bank loan, sorry, the loan notes, I do apologise. The cheapest one, I've lost it again, there is the bank loan at 5.25. Now, why is equity so much more expensive and the bank loan so much cheaper? All right, part is because of their tax saving, but what he's getting at here is it's down to the riskiness. That by creditor hierarchy, who gets paid out first? If the company goes bankrupt, then who's most at risk and who's least at risk? The way the money's paid out, secured debt is the first to get the money. The company goes bankrupt, secured debt, they're secured on certain assets, they're the first people to get the money. Who's next to get the money? The unsecured debt. Whatever money's left goes to them. If there's still money left, who's the next? Preference shareholders. And if there's any money left after paying off all of them, only then do the ordinary shareholders' equity take what's left. So this is the order of payout on bankruptcy or liquidation. And so who's most at risk? Equity is most at risk of not getting anything. Who suffers the least risk of not getting anything? The secured debt. And that's the relationship he's talking about. The further down the list, the more risky we are, more risk of not getting anything. And therefore, the further down the list, the higher the required return. Now, all right, don't just show it as a diagram, but I've said I don't have to write an essay on the screen. You can read his answer. And that's what he's getting at. That, and it fits in with our example. You don't need to relate it to it, but equity, the most risk of losing the money. Therefore, I'm not surprised it was the highest at 10.1. Preference shares were next. The other two were very similar. I say part of the cheapness was due to the tax saving, but that's not asked here, that's not relevant. But you'd expect them to be cheaper anyway. It doesn't make any mention whether it's secured or not secured. All right, that's part B. What about finally C? And this one completely independent, nothing to do with parts A and B at all, but explain the differences between Islamic finance and other conventional finance. Well, again, the examiner's written quite a bit and read it, but it's more than he expects, because as always he knows people learn from his answers, so it's good to read. But the main points you should make, and you should have been able to make, is that with Islamic finance, first of all, interest is forbidden, charging interest. Whereas, of course, conventional finance, ordinary borrowing, as we've got in this question, interest is charged, but with Islamic finance, they're not allowed to charge interest. That's riba. Doesn't matter about using the word, but whatever. What else? With Islamic finance, investors or lenders must share the risks as well as the rewards. You're not expected to go into detail here about these different things like sukuk and muduraba and whatever they are, but just the principle that you can effectively lend money, but you don't charge interest. You share in the rewards, but you must also share in the risks. If things go badly, you lose. If things go well, fine, you can gain. And the other big thing is, of course, you can only invest in, I'll put ethical, I'm not sure I'm using the right word here, investments. Depends how you define ethical, but perhaps it'd be better to put it the other way around. But you can't invest in things like gambling companies. It's got to be ethical in that sense of the word. So there we are. I mean, again, although he's written more, if I'd written that a bit slightly more neatly, that would have got me most, if not all, of the 4 marks of Part C. All right, so which question was that? That was question 4.